You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, guys, welcome back to episode 198 of the Young Investors Podcast.
We are getting close to 200.
We're going to do anything for 200?
That's what I was thinking. We need to. What did we do? We did something at 50. I think you were in Melbourne for 50. I think we did something for 100. I can't remember what it was. It was either in Sydney or it was in
yeah, I think
Melbourne.
It might have been that Sydney episode. Yeah,
could have been. Did we do anything at 150?
I think that we couldn't
because of COVID.
Because like COVID and stuff, I don't think we could do very much. So, but yeah, we should try and do something. I don't know. We'll try and figure it out. We'll make it special in some way.
It's really crept up on us. So we'll have to. We really should be doing something. 200 is crazy. We were just talking before off air about how that's basically 4 years. Which is it's just where's the time gone?
It's a long time. Where does the time go, Hamish?
Yeah. There you go.
Yeah, pretty insane. But how you going? How you going down in Melbourne? You doing all right?
Going all right. Watched the footy over the weekend. Did you? It was a bit of a lackluster game, unfortunately.
Oh my gosh.
Yeah,
it was terrible. Well, I went on a bushwalk, so I went down past Eden to do the light to light bushwalk. It's just a beach bushwalk between two lighthouses. It was really good actually, but I was there with my best mate who's a Swannies supporter. And we were trying to watch it, but the internet was flaky, so we ended up listening to it, but we just turned it off after a while because it was it just wasn't it, was it? The Cats were just way too good.
Yeah, you didn't miss too much. It wasn't that much of an exciting game. So
no, unfortunately for the Swannies, they got rolled. My mate wasn't too happy, but and welcome if you're listening to us from America or the UK. Yeah, you have no idea what we're talking about. We are talking Australian football, or the AFL, the Australian Football League, which is actually, I learned not too long ago, is actually one of the highest attended sports in the world on average.
Wow.
I can't remember the exact numbers, but because our stadiums, because it's such a big field and our stadiums are quite like, they're like cricket grounds really, but capacities, like the capacity of the MCG is like 100,000.
Yeah.
A lot of the stadiums around have capacity of at least 50,000.
Yeah.
And on average, it's actually quite highly attended, comparably compared to a lot of other sports around the world.
Yeah. You know what I've always wondered? Why is American football called football? They don't really use their feet. Like, I mean, I know there is kicking, but they're mostly using their hands and like throwing the ball. Why is it football? Someone explain that to me, because every other sport that's called football actually uses their feet. So there you go.
That's a fair point. It's interesting as well. A lot of Australian footballers end up going over to America to be the
kicker,
punter,
kicker,
punter, whatever.
I don't even know what it's
I'm
called.
not sure. In an American football team.
Yeah.
Because I don't know, it's a skill that's not really well developed, I think, through the American football system, and we do it naturally because it's like the fundamental skill of the sport that we play.
There you go.
But there you go. Anyway, welcome to the Investing Podcast. As per usual, we've gone on this massive tangent that's completely irrelevant. But we've got some stuff to talk about. Oh my gosh, we've got such a big story. Guess what, guys? Hometown International. It's back, baby.
It's come full circle.
It's come full circle. So Hamish is going to talk about that today. I am going to talk about an interesting New York Times article which really goes deep into the conflict of interest with stock trading in the US political system. So I will talk about that. There's some very interesting insights there. The UK, very interesting. They're going to scrap the cap on banker bonuses. So we'll talk about that.
Okay.
I don't know how well that one's going down over in the UK at the moment. And of course, we'll talk about this maybe at the start. We do have the update we were talking about last week. The Federal Reserve did hike interest rates. We'll talk about that in a minute. We've got a couple of questions as well.
Yes.
So we'll go through some of those at the end.
Yeah, so today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker using Excel, or you can also do it one by one. And once you do that, it will track all of the gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans on your ETFs or individual stocks, it will do all of those calculations for you, which is an absolute lifesaver. Currency gains, if you're buying shares internationally or you hold foreign currencies. Again, we've mentioned this a few times with interest rate hikes in different countries. There's a lot of fluctuations going on between currencies at the moment. So if you're in the UK and you're investing in the US, or you're Australian investing in the US, or any of these combinations, being able to track the difference in currency fluctuations to get an actual view of your portfolio's return, your real return, is critical, and it's very difficult to do on your own in Excel. So using something like Sharesight is a lifesaver. You can also use Sharesight for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used to track the performance of your portfolio, as well as use the tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, track up to 10 holdings for as long as you want, or you can sign up to a more premium plan. And if you use our link, you'll get 4 months off a yearly subscription. So it's a great deal. Go check it out. And as always, thanks to everyone who is using that link when signing up and is supporting the podcast.
Yeah, for sure.
All right, we better start.
So what we went through the inflation numbers last week, but that's right, because we said we didn't quite have. Yeah, it was like going to happen the next day. Yes. What the Federal Reserve was going to come out with.
Yes, yeah. I think we record the podcast like one day earlier than normal, because we usually catch the interest rate hike just as it usually comes out like in the early morning of the day that we record, because we record on a Thursday. We recorded a day earlier, so we missed it, but we had a pretty.
It was the Queen's Death Day long weekend.
That's right. Yeah,
that's what it was.
Yes, and I mean we had a. I mean, I don't have too much insight into the ins and outs of the monarch, so.
So the Queen's birthday, we got the Queen's Death Day now.
Yeah. Oh, geez. Oh, boy.
Anyway.
Do they get rid of the Queen's birthday? Like, do they just change it to the King's birthday?
It's just the King's birthday. But the Queen's birthday long weekend was never like the Queen's birthday.
No, it
anyway.
wasn't. So that's why I'm wondering, maybe they just change it to the King's? Or do they get rid of it?
I don't even know. The date might even stay the same. It'll just be called the King's birthday.
I hope they don't get rid of it, because it's always a long weekend over my birthday. So,
okay.
Yeah, I hope they.
No, they won't get rid of it.
Yeah, hopefully they just change the name of it or something. So, yeah, there you go.
Yeah.
Anyway, unrelated to the Federal Reserve.
There we go again, Hamish. There we go again.
We're pretty good at that. I mean, we spoke about it last week. There wasn't really too much. There was pretty much a consensus that the Fed was going to increase rates by 0.75%, and that's exactly what they did. So they didn't give us any surprises. They didn't shock us with a 3% rate hike or anything crazy like that. So they did a 0.75, and they essentially brought the official cash rate into the range of 3 to 3.25%. So it's getting up there now. Not long ago, I think it was a year ago, maybe a year and a half ago, that it was at 0. I think a year ago it was at 0, because even at the start of the year, we were just doing the first couple of rate hikes. So, very quickly it's gone to 3.25. And I think I mentioned this a little while ago, but the average since 1970 for the official cash rate has been 5.4%. So they're about 1 to 1.5 rate hikes away from being average, getting back to normal.
The fact that surprised me, that it was as high as what it is, just shows you how low interest rates have been in our our whole lifetime.
Yeah, I think.
Well, our whole adult lifetime anyway.
Yeah, well, certainly the last decade, since 2010 has been well below 5%. I think even between 2000 and 2010. I'm not sure how high it got, but I think it approached 5%, but it was maybe 4% was the high during that decade. But regardless, I mean, we've gone a very, very long time since seeing anything north of, or much higher than 5%, let's say.
Back in 2004-5, rates started going up, and they got up to about 5-ish, just over 5%.
Right.
Yeah, it was back in after, it was like probably 2001. I'm sorry, I'm just reading off a graph and they don't actually have the accurate axis on the bottom. It was probably about 2001 where rates were just over 6%.
Right.
Then they dropped down. 2004 was the low. 2005, 6, 7, up to 5%.
Yeah.
And then after 2008, drop down to 0. It made a little bit of a rise after 2016, 17, 18, 19. And then up to just over 2%, but then back down to 0, obviously, after coronavirus.
Yeah.
And now up.
They tried to raise rates in 2019. They did like 3 mini hikes, I think I remember. And then the market went down like 20%. And they were like, oh, we didn't mean that. Oops. Oopsie-daisies. We won't do that again. But it is interesting to see it kind of get back up there. A couple of quotes from just the press release from the Federal Reserve. They said the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. I'll talk about that. So that's kind of their indication of continuing to do this quantitative tightening, reducing their balance sheet. I'll talk about that in a second. And then they also, just another quote was, the committee is strongly committed to returning inflation to its 2% objective. So essentially them coming out and saying, we did another rate hike and we're not going to slow down until until inflation is around 2%. Which is good to see.
One thing that I took out of the press release as well, one quote that stood out to me, I only listened to the first kind of part of it, but I think because how there's been a bit of talk from some people where it's just like, well, if inflation starts coming down a little bit now, then maybe they won't have to raise interest rates anymore. I think Jerome Powell said something to the effect of, we know from history how damaging it can be when you start to back off the rate rises too soon.
Yeah.
He says something to that effect. That's obviously not his exact quote.
Yeah.
Which to me really just cemented the idea that they won't, it doesn't seem as though from his wording that they're going to just do a wait and see approach, like, oh, well, we've seen inflation calming a little bit, so maybe we'll just take it easy and see. That just, I do not get that impression at all.
Yeah.
So I think it's very likely that even if inflation continues to fall, that we will still see consistent rate hikes.
Yeah.
Until we're looking at something like what you say, their long-term average annual inflation rate of 2%.
Yeah, well, certainly I think that's the right approach. We don't want them to repeat. Them to repeat the 1970s where they went through, 2 or 3 bouts of inflation, and each time it slowed down a little bit. They eased off the rate hikes, and each time it just got worse and worse until
we prolonged the problem.
Exactly. So it's actually good to kind of hear that kind of perspective out of the Fed. In terms of quantitative tightening, so this month in September, they reached their full speed of how they're planning on selling Treasury these securities. So they're now selling, or at least this month they sold $95 billion worth of Treasury bonds and mortgage-backed securities to reduce the Fed's balance sheet. So way back when they were doing quantitative easing during the pandemic, they were essentially buying, I think it was $120 billion per month. It was like 40 and 80 of Treasury bonds and mortgage-backed securities to keep interest rates low, to kind of add buyers and demand into the market. Now they're reducing their balance sheet. So that's kind of another element that's adding downward pressure to bonds and increasing the yields on those bonds, which is what we've seen. If you look at any Treasury bond over the past few months, it's kind of just the yield at least is like a straight line up. So interesting to see.
Bond price has been falling. Yep.
Yeah, just a bit of a related story, something that I saw on Twitter, just kind of related to bonds and interest rate hikes, not in the US, but actually over in the UK. I saw this crazy chart of a UK bond, and I'll give it so we can put it on screen for those who are watching on Spotify or on YouTube, now that people can kind of watch on Spotify. But essentially, as interest rates have increased in the UK and newer bonds have kind of offered a better return, older bonds have been absolutely destroyed. And there's this chart of a 40-year 0.5 coupon bond, which is absolutely insane that you would lock your money away, that you would lock your money away for a 0.5% return for 40 years, is kind of insane. And if you look at the chart of this bond, of course, its price has to fall to reflect the new yield of the new bonds that are being issued. If new bonds are being issued at 3% and you have this 0.5% bond, you're not going to be able to sell it at full price. You're going to have to sell it for less so that it yields the equivalent, right? Because for a bond,
the price will fall. To reflect that.
Yeah, exactly. Because what you earn in return from a bond is the coupon, so the actual payment that comes from the government, but then also the difference between the price you pay for that bond and what you can sell it for when you get the kind of principal back at the end. And this chart is just insane. The price has dropped from $96 for I think it's $100 face value bond to $25, which is an absolute collapse. And I think UK's experiencing kind of the worst of this, but this is an effect that's happened across the entire bond market. It's been absolutely destroyed. But the thing I just why I think it was an interesting example is because you can kind of think of it as an example of an extreme example of overpaying for a stock. Because if you're buying a 0.5% bond for 40 years, it's essentially the same as buying a business that's risk-free essentially, and paying 200 times earnings for that business. So you're paying 200 times earnings because you got a 0.5 yield, right? So it's 200 times earnings with no earnings growth. So guaranteed no earnings growth because it's a bond. It just pays the same coupon for 40 years. So that's insane.
That's a really powerful way of putting it.
Yeah. And that's exactly why as interest rates rise, like that's just a great example of a stock. It's a bond, but as a stock that would absolutely get destroyed. And it demonstrates why businesses that trade at really high multiples get absolutely crushed first. It's the same concept. Obviously, with a business, there's variance in earnings, but you can use bonds. I think bonds are always such a good way. I know they're boring. They sound boring. They are boring, but they're a good way to think about businesses. Like Warren Buffett talks about how it's kind of like a stock is a bond, just the earnings haven't been printed on it yet. Whereas a bond, you know what the earnings will be. So
that's what we do with our discounted cash flow analysis. We're trying to turn a stock into a bond.
Yes.
That's what we're trying to do. Yeah. We're trying to say this is the cash flow we'll get out into the future and then work out what we'd be willing to pay for it.
Yeah.
So it is essentially turning a stock into a bond. That's what our process is doing.
Yeah. But I don't know who the hell was buying a 0.5% coupon 40-year bond. I mean, that's actually insane. But
well, there must be some. That's the thing. There obviously has to be some financial situation in the world where this might make sense. But you're absolutely right. Looking at it at face value, this just seems like the silliest thing in the history of silly things.
I couldn't give you a reason why you would buy that.
No, I couldn't either. I mean, maybe if you guys could tell us, if you guys have any ideas, like who out there, what financial institute, like where does this potentially make sense? I don't know, but maybe there's some people out there that are a lot smarter than us that might be able to tell us.
Yeah.
But probably not for the individual investor. It's probably not a smart idea.
Yeah, definitely not.
Not financial advice.
Yeah. All right, where do you want to go from here?
Oh, that's all we got.
That's
okay,
all we got.
No worries. Let's talk about. I'll talk about this. This is a New York Times investigation that they did, a real deep dive study that they did, and. The headline is stock trades reported by nearly a fifth of US Congress show possible conflicts of interest.
Shocker.
Yeah. But this is a really interesting article because it's going in deep and talking about what are the actual numbers? What are the actual scenarios behind all of the conflicts of interest? We always hear about some person sitting on some committee that's, deciding whether or not to, do something in the mining industry. It has all of a sudden sold their entire mining portfolio or something. It's just it seems so corrupt. I've got a couple of examples. This is how they open the the article. It says Senator Tommy Tuberville, Republican of Alabama and a member of the Agriculture Committee, regularly reported buying and selling contracts tied to cattle prices starting last year, even as the panel, by Mr. Tuberville's own account, had been talking about the cattle markets. So that's one example, but it gets worse. Representative Bob Gibbs, an Ohio Republican on the House Oversight Committee, reported buying shares of the pharmaceutical company AbbVie in 2020 and 2021, while the committee was investigating AbbVie and 5 rivals over high drug prices. Again, question. This seems a little bit corrupt.
A bit murky.
How about example 3? The timing of one trade by the wife of Representative Alan Lowenthal, Democrat of California, was especially striking. His disclosure statement said she had sold Boeing shares on March the 5th, 2020, one day before a House committee on which he sits released damaging findings on the company's handling of its 737 MAX jet, which was involved in 2 fatal crashes.
Yeah, that one's a little bit sus. But obviously, husbands and wives don't talk about their trades between each other. So,
of course not. Sons, daughters, nah.
It's just a coincidence,
Work stays at work, doesn't it? Yeah, clearly not. But so there's clearly some pretty obvious conflicts of interest going on. Anyway, it says here, these lawmakers, all of whom defended the transactions as proper, are among 97 current senators or representatives who reported trades by themselves or immediate family members in stocks or other financial assets that intersected with the work of committees on which they serve, according to an extensive analysis of trades from the years 2019 to 2021 by the New York Times. And interestingly, I just thought on top of that, this is a little tidbit from later in the article, the Wall Street Journal also reported last year that more than 130 federal judges had overseen cases involving companies in which they or their families owned interests.
Yeah,
insane.
Well, that sounds like just an obvious conflict of interest that just obviously shouldn't exist. That is ridiculous. You'd think it would be relatively easy for them to determine whether that's happening. I don't know.
The thing is, these guys are the ones that make the rules. So if they're in a position where they're going to profit off of doing this, it's very unlikely that they are going to change the laws that go against their own financial interests.
Yeah.
So,
I mean, if it's in the same industry, if they're talking about the same businesses and they're making laws about particular businesses, then that should be an obvious conflict of interest. I'm not sure I'd go as far as saying they can't trade at all. Maybe they have to set up some kind of structure like executives do, where they often make their trades, they schedule out their trades. So if it looks like there's a conflict of interest, then they're hands off for the trades for the remainder of the year. They kind of schedule out when they're going to buy. Maybe they could do something like that. But yeah, it is. there's just so many cases. I think there's a Twitter page that follows Nancy Pelosi's trades. And they've done pretty well.
Yep. Yeah. It says here, over the 3-year period, more than 3,700 trades reported by lawmakers from both parties posed potential conflicts between their public responsibilities and private finances. These 3,700 potentially conflicted trades identified by the analysis amounted to more than 10% of the transactions by members of Congress in the Capital Trades database during these 3 years. That's the database that was used for the study. In some cases, the transactions appear to be routine or to only have a tangential connection to any influence the lawmaker might have had on the issue. In others, the trades were conducted by trusts or brokers who, the lawmakers say, were operating without any instructions or inputs from them. So that's, I guess, another way where you could do it, where you have an independently managed investment portfolio.
Yeah.
But it does get a little bit sus where they're sitting on these oversight committees or whatever, and they're actually having an influence on the outcome, and then they're personally trading in and out of these stocks at the same time. It seems like it just seems corrupt. It seems very corrupt. There's no other way to say it. It seems like something that shouldn't be allowed to happen. It seems like it goes against the public's interest.
Yeah,
and they're supposed to serve the public, but clearly these structures or these things are allowed to happen and they get abused. So
yeah, and maybe it is just too hard to tell who is doing legitimate trades and who are, doing trades that shouldn't be allowed. Maybe it just should be not allowed at all. I don't know. It is a difficult kind of question to think about. I don't know. Yeah, it is. Unfortunately, where there's humans and power, there's corruption.
Yep. So let me tell. So that was in some cases they appear to be routine, some cases not so much, but many instances show how legislative work and investment decisions can overlap in ways that at a minimum can leave the appearance of a conflict and that sometimes form a troubling pattern even if they technically fall within the rules. So with that said, what are the rules? So under a 2012 law known as the Stock Act, members of Congress are allowed to buy and sell stocks, bonds, and other financial instruments as long as they do not trade on inside information and disclose any transactions by themselves or immediate family members valued at $1,000 or more. They do not trade on any inside, and they disclose any transactions by themselves or immediate family members valued at $1,000 or more within 45 days. So they do have to disclose this stuff. But then it goes on to say, like everyone else, members of Congress are subject to the laws against insider trading, but even knowledge that would fall short of the legal definition of inside information, though, has the potential to create ethical dilemmas for members of Congress who, on any given day, might be able to glean insights through legislative work, classified briefings, or meetings with constituents, donors, corporate executives, regulators, and other government officials.
Right.
So I think that is a fair summary. So they're still not allowed to do any insider trading if they have inside information. But then again, what they are doing sounds like they have something that is very close to inside information, or they have the ability to pry out information that is not yet public.
Yeah. I don't know. It's crazy.
Yeah.
I don't know.
So anyway.
Yeah, go on.
That's all right. So what's being done about it, you may ask? And this is just all, by the way, this is all from this New York Times article. They do a really good job in summarizing all of this. So what's being done about it? Well, both the House and the Senate have been trying to develop legislation to tighten the rules, but whether a bill will be passed by both chambers and make it to President Biden's desk this year remains in doubt, despite rare bipartisan support. That surprised me.
Really?
I'm not quite sure. I think there might be a lot of course I support this bill.
Yeah.
Public.
Yeah.
You still
but
like
it's not
me,
going
right?
to happen.
When it comes down to it, they'll be like, hell no, throw this thing out.
Yeah. It's hard to imagine that's
we'll
going to be, at the forefront of their agenda in terms of things to push through.
Yeah, we'll leave that one for another time. Let's focus on this other thing. But interestingly, so there are some people that do support it in Congress. Quote, the American people don't want us day trading for profit and engaging in active trading of the very equities that are connected to the policies that we are deciding on and voting on every day, said Representative Chip Roy, a Texas Republican. He is co-sponsoring a bill in the House that would require members to put individual stocks, bonds, and many other financial assets in a blind trust, a portfolio that is managed by an outside advisor with no involvement by the owner.
Yeah.
So that makes sense. I think that's probably I guess the best way you can go about it, because I probably agree with you. I believe that, everyone should be able to partake in investing.
Yeah.
Because everyone, we're all equal. Everyone should be allowed to partake in that system to try and build their wealth, because we all know that investing is a great way to secure your financial future. So fair enough, everyone should be allowed to do that. But I think there's got to be some rules, especially when you have that much power. So I think what you were talking about before, what was your point again?
I can't remember. What did I say? I can't even remember what I said.
But I think this point here where it was either putting them in a blind trust or, yes, what you were saying before about the scheduling.
Yeah.
So you can do what you want, but you can't necessarily get a new tidbit of information and be like, quickly buy Boeing or sell Boeing stock and buy AbbVie or something like that.
Yeah.
It has to be like, 3 months out, I will sell this stock or something like that.
They could even just stop day trading, as that kind of last guy was kind of alluding to. I mean, even they could allow you to make long-term investments in a way, which I guess you could still trade on inside information, but there could be some kind of holding period. So you can't be trading in and out of shares based on legislation that's going through. So you could do that. But I guess the easiest and most convenient probably the most effective would just be to have as that guy said, a blind trust where there's some other kind of asset manager who's controlling all of the really I mean, even in that circumstance, like the person's hired a financial manager. I mean, I'm sure there's really nothing stopping him from picking up a few phone calls between the two.
Exactly.
But you can't. Yeah, I mean, you can't really. There's no perfect fix for it, I guess. So you've just got to.
I reckon tighten the rules and actually have some. That's the other thing. Have some sort of regulatory board that actually watches really closely what's going on, because I was looking like this article's talking about that reporting rule that I was just discussing before. I've lost where it is. Oh yeah, when disclose transactions made by themselves or immediate family members valued at $1,000 or more within 45 days.
Yeah,
like this article was saying, like half the time the disclosure's late. Sometimes they don't even disclose it. Like they just don't bother to put in their disclosure, and like nothing happens.
Yeah.
So it seems like it's a loose system.
Yeah,
it was interesting actually. The article spoke about. Hang on, I'll try and find it real quick. There was an interesting case a couple of years ago where I can't find it. I cannot find it. Oh yeah, a rare insider trading prosecution of a member of Congress, Representative Chris Collins, Republican of New York, resigned in 2019 after pleading guilty to charges related to giving his son insider information about a failed drug trial at an Australian biotech company on whose board the lawmaker served. So he actually went to prison, although guess what happened after he went to prison?
What happened?
For pleading guilty to insider trading based on information that he got through his job. He got a presidential pardon by Donald J. Trump.
There you go. Wonderful.
There you go. Anyway.
Donald Trump's got your back, so.
Yeah, the old Donald's got your back. He'll let you out. Don't worry. You want to abuse your power and make trades and insider information and make a shitload of money and go to jail? Don't worry.
As long as you're a Republican, you are fine.
Yeah. So it does seem like there's some sort of policing. This is probably quite an egregious example, but so it's probably pretty obvious. But yeah, some sort of regulatory board oversight, something like that might be good.
Yeah, I would imagine that the internet has probably played a pretty vital role in all of this becoming like kind of a popular idea that we want to crack down on this, because I'm sure things like Twitter have played a big role in being able to actually track all of these trades now, whereas previously it would have been much more difficult to get all of the filings to see what they even have in their portfolios, and then whether the internet has kind of just opened up all of this information, and we've been able to finally see what these people are doing. So
it's true. You can go like to Twitter, and I think there's like Pelosi stock tracker.
Yeah,
it's just an automated Pelosi stock. Yeah, Nancy Pelosi stock tracker at Pelosi tracker underscore. It'll just give you it's automated like information, a little update whenever she makes a move.
Yeah,
it's pretty funny.
Yeah,
and some of them do well, but I was actually looking. It's kind of karma. The article actually went into whether they do beat the market, and they don't. Overall, as a large group, they don't.
There you go.
At least there's that. At least they could have done better money. Just buying ETFs.
Yeah. Oh, that's pretty funny.
Still, I'm sure a lot of them, some of them probably just have no idea what they're doing, but some of them I imagine are probably pretty good.
Yeah, well, I think Pelosi's worth like $200 million or something. So she hasn't gotten that from a $300K a year working in Parliament and working in government.
Yeah.
So
yeah.
Oh boy.
Yes.
All right. Should we talk about Hometown International? Should we?
Oh, please.
We've finally had an update. This is so we spoke about Hometown International. This is our favorite stock. This is the stock of the Young Investors podcast. No, we spoke about this company.
Delis. Yeah. They go straight in my circle of competence.
Yeah. Yeah. It's only one as well.
You're going to talk to me about meats and cheeses? Whew, I'm there.
Yeah, exactly. No, so this, I went back and had a look. So it was episode 124 or 126, something like that, that we first kind of heard about this company. So go, if you want to hear kind of the original story, I'm going to rehash it a little bit. And I actually did a video on this as well. So there's lots of hometown content out there now. But so this was well over a year ago. We kind of first heard about Hometown, and I'll give a bit of a background on it. We first kind of came across it from David Einhorn, who is an investor and does quarterly letters to his clients, his investors, and he uses kind of those letters to talk about market speculation and what's going on in the economy and that sort of thing. And he kind of spoke about this company called Hometown International, which is an absolute absurd company to be listed on the stock market. It's a single New Jersey deli which was worth $100 million. At the time, just a single deli in New Jersey. I think it did like $20,000 in revenue in 2019. It then did $15,000 in 2020 because it was closed for 4 months or something. Like,
wow.
It's and it was worth $100 million. I mean, this is the biggest shareholder. So the owner, essentially, he was the CEO, the CFO, the treasurer, the only director. He was the wrestling coach of the school next door. So
that's right.
It was just an absurd story of a company that obviously kind of didn't deserve. It just had no place being listed on the stock market. It stood out.
Absolutely not.
Yeah, it stood out terribly. So that kind of raises some questions about, how did they even list in the first place? And I think you asked me this in that episode, and I didn't really have the answer at the time because I had just actually seen that story that morning. But they were listed, and how they were able to list essentially was on the OTC markets, what's called the over-the-counter markets. And this is essentially it's basically like a third kind of option for companies to list in the US. So there's kind of the New York Stock Exchange and the NASDAQ, which are the two major stock exchanges. And those are centralized exchanges. So they kind of act as like an intermediary between investors wanting to swap shares. And it's actually very difficult to get on, as you would expect, to get onto those two exchanges. There's a lot of regulatory work that you have to go through. And there's a lot of there's quite a high criteria that you have to pass. But there's a third option, which is called the over-the-counter markets. And it's actually fairly easy to get onto the OTC markets. And it's different from the New York Stock Exchange and the NASDAQ because it's decentralized, and it essentially just allows investors to trade shares directly to one another. So instead of there being an intermediary, you're trading directly with an individual. So it's a bit of a different kind of system. It's easier to get on, and that's how they were able to kind of easily get onto that market. But essentially, it kind of just looked like at first a case of just an illiquid speculative stock. So there's a lot of stocks on the over-the-counter markets that don't have much volume. People aren't really trading the shares. So their prices and their valuations kind of just fluctuate pretty significantly. So it kind of just looked like that.
On only small volume.
Yeah, and I can't remember. We didn't really kind of speculate too much about what was causing it at the time, I think, last year. Did we? I don't remember.
I can't remember.
I don't remember too much. I think we kind of just thought it was a speculative, irrational example of a business. Maybe it could have been a pump and dump. So, this owner of the deli, maybe he was just trying to, get a lot of enthusiasm about the stock and then dump his ownership in it. Maybe it was getting swept up in kind of retail investor speculation. But it wasn't any of those things. It's actually far more interesting, I think. And we found that out this week. So This week, owner James Patton, Peter Coker, and Peter Coker Jr., so a father and son duo, were all charged with wire fraud and manipulative trading.
Oh my God.
So they were just running a pump and dump. This wasn't just a crazy coincidence that the stock had gone up. They were purposefully manipulating the stock to achieve something.
Right.
And it turns out that they were trying to create a shell company that could then be used for what's called a reverse merger. So what is a reverse merger? Well,
yeah, that's my question.
a reverse merger is essentially where a private company merges with a shell company that's public. So a company that's on the stock market, a shell company being one that doesn't have really any assets, doesn't really have any operations. So it's basically just it's a shell of a company, right? It just kind of sits there. So it's where a private company that does have operations, it is a real business. They want to go public, but they don't want to go through an IPO because there's a lot of regulatory scrutiny. They don't want to go through the traditional process. So instead, they just merge with a company that's already public, a shell company. They essentially merge with them, but they basically buy that company, and voila, they're listed.
They're on the market.
They're on the market, right? So that's what a reverse merger is, and a reverse merger is actually almost the exact same as a SPAC. A special purpose acquisition company is basically the same thing. The only difference is in a SPAC, they create a new shell company. So that's what the special purpose acquisition company is. They create it specifically to acquire or to merge with another company that's private to take it public. Whereas a reverse merger is where they do this with a shell company that's already got operations. It's just basically the bones of or the carcass of a old business. So SPACs and reverse mergers are basically the same. And that's what they were trying to do. And a reverse merger can be legal. Of course, it's not something that's illegal. But the way that Hometown was going about it was absolutely not legal.
Right.
So essentially, Hometown had, even though they had, in the end, we were kind of looking at them and they had a value of $100 million. Besides some of the illegal and fraudulent trades that the owner was partaking in, Hometown had no volume. So nobody was trading the stock. Actually, sometimes it went like 3 weeks, 4 weeks without anybody trading it. So it was really easy for Patton and these two, the Coker father and Papa Coker and son Coker essentially they faked a bunch of trades to make the share price go up, because how trades work on how kind of the market cap and the share price on the over-the-counter markets work is as long as the trade is more than 100 shares, then whatever the last trade is, that's the current share price, and therefore that's what the value of the business is. And since nobody was trading the stock at all, they just set up a bunch of fake accounts and just traded shares between each other to make the company worth over $100 million. So they did this for a while, and then essentially made themselves attractive to be a potential candidate for a reverse merger. And then they actually did a reverse merger in April of this year. So they merged with a company called Macama, I think it's called. Although I doubt that it's probably not going to go through at this point, given the owner has been charged. But yeah.
Wait, so is this a separate entity that they have nothing to do with, this Macama?
Yeah, so Macama is just they're a bioplastics company. That's just a business. That's a separate business that wants to go public, right? But they don't want to go public through an IPO because that's too much regulatory scrutiny. They would much rather just find basically a fake company to merge with, and that way they can list without having to go through an IPO. And then the Macama CEO essentially said after the merger went through, they were very shortly after that going to just transfer the shares onto the NASDAQ, which is kind of a sneaky backwards path that companies can take to go public without having to IPO directly onto the NASDAQ, for example.
Wait, sorry. So Macama wanted to go public. So they were going to nestle themselves into Hometown International.
Yeah. Yeah. So Macama was just looking essentially for any public shell company that they could merge with and essentially take over. And and that way they can get public. So,
so what was the point? I'm not sure what the point of the whole raising the market cap artificially was for.
Yeah, I think it's just to make the business have a greater perceived value, so that it can be attractive to a genuine company that's trying to go public. They actually did this with another company called eWaste, where they basically did the same thing, where the share price when they put it on the OTC markets was just 10 cents, and they essentially faked trades to get it up to $10, to get it up to over $100 million again in value. So I think it's just the idea of giving it perceived value as a real shell company. No,
right.
I guess.
Okay.
Yeah.
Okay.
So
there you go.
There you go.
So they faked a whole lot of trades. They made it worth $100 million, and they wanted to get Makama to come in.
Yeah, and I presume that's probably not going to go through. All three of them in Hometown are now facing 20 years in prison. So, wow. I don't think that merger is gonna quite go through. But there you go. It's a twist that I didn't expect out of Hometown. I thought it was just I don't know. I didn't.
The thing that worries me about this is what's going to happen to the wrestling department of this little girls' school.
I know they're not going to have a coach anymore.
They don't have a coach. Man, that's so sad.
That's a disaster. I told them they should have just merged with the wrestling team. They should have brought the wrestling team in. You said they could advertise the deli meats through the wrestling team. That would have been perfect.
Sure, wrestlers like to eat deli stuff.
Yeah, they wouldn't need to fake trades. I would have bought that for $100 million.
They're going to lose their spot. I bet you the wrestling team, they're like Hometown International plastered all over their shirts and everything. What a sad ending to this story, Hamish. What a sad, sad ending.
So there you go.
Well, there you go. The most bonkers story that I've heard in a very long time in the stock market has come to a very sad, sad ending.
Yeah.
There you go. You can't win them all, guys. That's all right. 20 years is no time.
Yeah. They'll be...
Nah, fair enough.
They'll be back.
Fair enough. That sounds pretty dodge what they did. Well, anything else to talk about with Hometown International?
No, I think that's it. We'll leave it there. The end of an era.
The end of an era.
The end of an era for Hometown International.
Oh, dear. All right. Well, let's talk about... actually, how long we been? How much time we got? Oh, we got time. UK. There's a lot of it, man. Liz Truss is having a jeez, what a start. Anyway, she's not doing herself any favors at the moment because she's recently announced plans to scrap banker bonus caps in a deregulation drive for growth. Apparently,
right?
Yeah, I mean, surely cost of living crisis.
Yeah, everyone knows
energy crisis.
Everyone knows growth comes from bankers.
Yeah, first thing we got to do. We got to get rid of the cap on bankers' bonuses. That sounds popular. That sounds like the right political thing to do. Yeah. Anyway, let's talk about it, Hamish. Britain will scrap a cap on banker bonuses, its new finance minister said on Friday, pledging an ambitious deregulation of London's financial industry. Geez, doesn't that sentence just give you the heebie-jeebies? Ambitious deregulation of the financial industry. Oh, I can't see that going wrong. To boost growth, but sparking fury from critics for helping the rich in an economic downturn. Yep, makes sense. The cap limits bonuses to twice a banker's basic salary with shareholder approval, and was introduced in the European Union to curb excessive risk taking after taxpayers had to bail out lenders in the global financial crisis. Makes sense. Britain and the Bank of England have always opposed the cap, introduced in 2014, saying that it simply bumps up basic pay. So instead of their remuneration being all tied to bonuses, because there's a rule that the bonus can only be double what the pay is, instead they just make the basic pay a lot higher so that their bonuses can be double that.
Makes sense.
So that's kind of the argument against this, this is the argument for there being, getting rid of this. It says, quote, all the bonus cap did was push up the basic salary to bankers or drive activity outside of Europe. It never capped total remunerations.
Right.
As a consequence of this, we are going to get rid of it. Finance Minister Kwasi Kwarteng said. It says, though, the decision comes at a sensitive time, however, in the midst of a cost of living crisis that has forced the government to spend tens of billions to help households and businesses pay their energy bills. Quote, this should have been a cost of living budget, but instead it's a banker's budget, said Fran Boate, executive director at Positive Money, which campaigns for a fair financial system. Quote, rather than handouts for the richest, a much better use of borrowing would be public investment. What are your thoughts, Hamish? I mean, it's a bad look, isn't it? This is literally one of the first things that Liz Truss is like literally one of the first things. Scrap the banker's bonus.
I'll be honest, I'm not in favor of heavy regulations where there's caps on bonuses. And I think, as you kind of explained, generally speaking, if a business wants to pay people a certain amount, they're going to find a way to do it anyway. So I'm not actually super in favor of the cap, so maybe the rollback of it is I'm not super offended or anything by that. But the thing I think that is bad is that obviously they're doing this instead of other things that they could be doing to help other people who maybe are not making as much money. And I think that's where it's like the decision to do this in front of other things. I think that's, it's definitely it's a bad look, and it's definitely not a good thing.
Politically, well, maybe like on your list of things to do, put the whole banker's bonus thing just like down the list. The thing that like gets me is this is like literally one of the first things that Liz Truss has done. Yeah. Like it's not even like, oh, now that I've been in power for 2 years, I mean, let's have a look at this banking regulation, financial it's just like, right, now that I'm in power, bankers' bonuses, let's get rid of that cap.
Well, I guess that's what you do as a politician. You do all the stuff that people hate first, and then when election comes around, you do all the stuff. Okay. you do all the actual good stuff, because no one's going to remember. Right. You think people are going to remember this by the time the election comes around? No one will even know this even has happened. Whereas they'll remember that 30 days before the election, I don't know, she did a tax cut or something. So,
well, I think they've already done tax cuts. I think Ray Dalio said like a scathing, like he thinks the entire UK government is like severely incompetent. I think they were like his words. Because I don't know. I can't tell you why. I can't remember what I was reading in the article. But he was just like looking at their financial moves so far with like tax cuts and all this sort of thing. He's just like, what is going on here? I think this is stupid.
Yeah, I'm pretty sure it's the UK that's doing rate hikes, but they're also doing quantitative easing at the same time. So I'm pretty sure it's the UK.
That's strange.
So yeah, it's kind of a weird thing to be doing. They kind of fly in the face of each other, but. But I'm no expert in the UK central bank or the UK government and what they're doing. But it's not great.
Yeah, not a good political look though overall. Quote, to many who were scarred by the consequences of the 2008 global financial crisis and the banking scandals that accompanied it, news that caps on bankers' bonuses may be abolished will trigger a response bordering on visceral, said Michael Barnett, a partner at Quillen Law. Reintroducing what is perceived as one of the more insidious elements of a culture that no one wants to see return carries risks that incentivizing the sale of financial products will always bring. The Bank of England and other UK restrictions on bonuses, such as limiting how much can be paid up front in cash and clawback of a bonus if there has been misconduct, should remain.
Well, I think that's a different issue, right? I mean, you could have regulations around restricting bonuses of meeting certain targets in terms of the sale of financial products, because that, of course, you don't want to incentivize people to be shilling financial products onto people who don't need them and shouldn't have them, right? I think that's a different issue to just a bonus cap altogether. The bonus could be for something unrelated, but I guess maybe if there's no cap, then you can't really police that. But I don't know. But I guess finance is like probably like medicine and some other industries. It's one of those unique industries that requires special regulation, definitely more regulation than other parts of the market, just because of the nature of the business. And yeah, you don't want to be incentivizing people to take more risk with money that's not theirs, essentially.
Yeah, exactly. Yeah.
especially when these businesses,
here we go.
Yeah, and especially when these banks are just too big to fail, as we've already seen once. So like the government's not going to let people lose their savings. So you have to, yeah, it does make sense that they need to have a tight grip on what these bankers are doing, so we don't have a repeat. But yeah,
indeed, Hamish.
There you go.
Indeed. Yeah, I do think that there just needs to be some sort of regulation as to what, how these bonus structures can be set up. Because, I mean, if they're the head of investments and they make some great investments and they make a lot of money for their clients, then, good on them, as long as they weren't, like, doing stupid risk-taking. Yeah. But you're right, I think what this says here, where there should be a limit on how much can be paid up front. There should be rules around, being able to claw back bonuses if there's been some sort of misconduct, all that sort of stuff. That should definitely remain. But anyway, there you go.
All right.
Interesting, Liz Truss. Good luck.
Well done.
With answering those questions in the media. Should we do a couple of Q&A questions before we get out of here?
Let's do a couple of Q&As. We're going to
should I ask you this one? Because I said I would ask you this. Because I spoke about this one with Tom.
All right.
Do you want me to ask it to you?
Yeah, for sure.
All right, no worries. So it says, it's Australian reporting season. I own shares of a handful of companies that I think are great, and their annual reports have come out over the last few weeks. Most have shown my companies are executing as planned. As you know, annual reports come out after the market closes. Frequently this year, I have read an annual report in the evening it came out and have been satisfied, and then the following morning there's been a big sell-off in the company's shares, as if others were reading a different document from me. Am I meant to be happy because this offers a buying opportunity, or do I ignore Mr. Market shouting prices over the farm gate? At what stage do I worry that I'm really wrong? Is this how Hamish felt about Netflix? So I just answered this with Tom. So I'll leave this one for you, I guess.
Yeah, I think, certainly that's something we're going to see a lot of. We have seen a lot of this year, and we're going to continue to see. And that's really because the market reacts on short-term news, right? So hopefully you're satisfied after reading the annual report because you have more of a longer horizon. And when you're reading through the short-term problems that the business is facing, you recognize that they're short-term problems and they don't concern you about, or maybe they don't have an impact on where the business will be long term, but the market cares about the short term. And yeah, you're right. It's exactly what I've seen in Netflix over, I think, 2 or 3 quarters now. Because especially Netflix, they've always had a history of moving aggressively on subscriber numbers. For some reason, the market is absolutely obsessed with the next quarter's, how many subscribers they have in the next quarter. So
true,
even before this year, this year's been particularly bad in the short term. Like they missed a number and then they dropped 30%. But if you go back any time over the past 5 years, they have regularly 15-20% swings after earnings. So it's actually not, if you put it in that perspective, it's just what you expect with Netflix, unfortunately. Yeah. But yeah, I think in terms of, should you be happy? If the price it falls within your buy range, then yeah, you should be happy. I think we don't let the market price influence our decisions, but if the market's given you a great deal, you're not going to turn that down. So yeah, that's kind of my thoughts on that.
Fair enough. All right.
I'll ask you this one. How did you guys get your tickets to the Berkshire meeting last year? I'm interested in going myself this year.
Gosh, this is a bit of an ordeal. Yeah. Well, to go to the Berkshire meeting, you have to be a shareholder. So that was the first thing, is that we had to become shareholders. You can own B shares, thank God. Otherwise, there wouldn't be very many people going.
No.
So we, myself and Hamish both bought one share, one B share.
Yeah.
I still own
one
my
share
B share.
each.
You still got yours? Yeah, one share each.
Yeah, I've still got my share.
Anyway. I still got mine. I'm a proud Berkshire shareholder. Yeah, that's right. Warren Buffett, yeah. But we thought that we would just go with, I think it was NAB,
Yeah.
National Australia Bank, which is, for those outside of Australia, is like this probably the second biggest bank in Australia.
Yeah.
Yeah, behind Commonwealth Bank. So we thought we'd go through their share trading program just to make sure that we actually legally owned the share, because I think that the way they do it is Berkshire send you this form you got to fill out with your like holder number or whatever, and they'll essentially check you against the share registry, and then if you're there, they'll send you out however many passes you need. You can get 4 passes per shareholder. But then the debacle is that, I don't know how long it was later, we actually realised that not even through National Australia Bank do we actually have legal ownership of our share in Berkshire Hathaway. So we like totally mudded it up.
Yeah.
It turns out that it's one of those arrangements where National Australia Bank holds the share on our behalf, but on the share registry, it would just be National Australia Bank. So we totally stuffed up.
Yeah.
Luckily, luckily Tom could apply because he did have legal ownership through his New Zealand broker. So he applied. But even still, Berkshire Hathaway is stuck in the 1960s. So all of this is done by mail. So they had to send us, or did we have to fill out a form that we printed and sent to them in the mail?
Yeah, Tom received a form, had to fill it out, and then mail it back to the US, and then they would mail back the passes.
The passes.
Yeah.
Which is the stupidest thing. So we left Australia and Tom left New Zealand without passes because they didn't come in the mail in time. So we flew to America with no passes to the Berkshire meeting.
And actually one other thing on top of that, just as a backup, I also bought tickets from a guy in Omaha. So he lives in Omaha, so he got the tickets really quickly. I ordered some to come to my house in Australia, and they also didn't come. So we weren't shareholders. Tom's passes didn't come, and then my passes that I ordered just from a guy, I just got them off eBay. They also didn't come. So that's where we were heading to the US with no way of getting into this meeting.
Luckily, was it you?
Yeah.
How do we actually end up doing this?
So the guy that I ordered them off eBay, I let him know that they hadn't come in time, and he was actually great. He basically just came to where we were staying and dropped off some more tickets. He had like heaps of tickets somehow.
Right.
Yeah, and he actually gave us he was the same guy who runs that Bobble. It's Bobbletopia, I think, is an eBay store that he runs.
That's right.
And he gave us
the Warren and Charlie bobbleheads.
He gave us those bobbleheads that you see in the podcast and the videos that we did while we were over there. So yeah, shout out to
they're now sitting proudly in the background of Tom's videos, by the way.
Yeah,
so
I've
if you want to go see him, go watch some of Tom's content and you'll see them bobbling away in the background.
Yeah, so yeah, that's the story of how we got the tickets. I think you can pick up tickets at the door the day before. We just couldn't do that because we weren't shareholders. So yeah, we shouldn't have even been in there.
Definitely, we definitely got to fix that up for next time.
Yeah, we'll definitely.
Yeah. Anyway.
Oh well. We got a story out of it.
Yep, but hey, we got in there eventually. Jeez, that was just, man, we've got to go back next year.
Yeah.
Oh, I keep reminiscing about that trip. It was just so good.
It was great.
All the people that we met, from Guy Spear to Matt Peterson to Monish Prabrai, Lee Lu.
Yeah.
I mean, all these guys, like, we shook their hands, we said hello. It was just amazing.
Unbelievable.
And to see Warren and Charlie in the flesh, yeah, it was just fantastic.
Yeah.
It's just fantastic. Really, really fun.
Yeah, we'll definitely go
really,
back
really
for sure. For sure.
Yeah. Yep. All right. Well, I think that just about wraps things up for today, doesn't it? We are well out of time.
Yeah.
But yes, thank you guys very much for tuning in as always. We really do appreciate the hour of your time that you give us and support this podcast every week. And we hope it's entertaining. There's lots going on this week. So hopefully it's always nice when there's a lot of news to talk about, but hopefully that continues. Thanks always to Sharesight for sponsoring this podcast. And, of course, more details can be found in the description, show notes, whatever it's called, wherever you get the podcast. Of course, if you have any questions that you would like to ask us for the Q&A section, go over to either Spotify or go to YouTube and leave a comment there, and we'll drag them into the Google Doc and run through them as we do. But apart from that, guys, that will just about do us for today. Thank you very much for listening or watching, and we'll see you guys next week.
See you guys.
Bye.